Bearish 3 method formation. Now this is a really important formation. Why? Because it will help you save money. And if you are in short selling, then it will help you make easy money. I repeat, easy money. Because this is a reoccurring pattern and it is the best way to pick a fall. In this pattern, there are 5 candlesticks. And it starts with a long black body and is followed by 3 small body candles. So it's like simple. First there is a huge fall, then for the next 3 days or 3 candles, it tries to gain back. These 3 candles are usually green candles because they are closing higher, or they are opening at a higher rate and closing near the open. So basically from the last day it is still in positive territory. And then the last candle is a red long body candle, which is like a mayhem falling down. The 3 green candle are contained within the range of the first red body candle, the large red body candle. This pattern, if it happens on the high, then it is a sign of a reversal, and it is one of the most strongest sign of a fall. It's not a weak sign. This formation is considered to be a bearish continuation pattern. Now initially I told you that this pattern can help you make money, easy money on short sell. Now how do I say that? The 3 green candles that I told you, or you can see in the middle. Whenever there is a huge red body, then within the next 2 days it should be rising up extremely fast, eating the red body. But in this pattern, the 3 green candles try to go up, but they always fail to cross the high or open. And therefore on the 3rd green candle, you can put a short sell order, placing a stop loss on the high of the red candle. So you have everything covered. If it goes against you, that is crossing the red candle high, you're out. Otherwise, the next black candle is so sharp that first of all you'll be making huge sums of money in that, and then usually it falls off. So more money will be made. Easy peasy. That's what a bearish 3 method formation is. Now you will discuss on real chart so that I can show you how it really looks and how to easily interrupt it and place the trade. Bearish 3 method formation. Now this is a really important formation because it's a continuation formation, and that's what I call the way out formation as well. Now let me discuss further. This was an uptrend. If you look at it from here, it was an uptrend, right? Then it fell off. This is a red candle. It opened at 49.10, closed at 47.20. That's a $2 fall, approximately $2 fall. Then the next day it rose up from 47.40 till 48.20. The next day it opened at 48.40, closed at 48.80. Then the third day it opened at 48.90 and closed at 49.10. Now if you look at it, this 1 day fall was absorbed by these 3 days. It took 3 days and it never closed above this open. Now whenever you see this kind of formation, then this is a dangerous formation, because usually the next day this red candle comes in and this is a perfect bearish continuation pattern. These 1, 2, 3, 4, 5 candlestick. Once that happens, the price usually falls further. Just look at it. And that's really important because it's a bearish formation, 3 method formation. Now I call this a get out formation as well, because once a fall comes in, this kind of a fall, A major investor, example, if I own several shares and I see this kind of fall, and if you look at it, this is a weekly pattern. If I look at this, then these are the 3 weeks that I will be getting out. Now, this pattern can come in at any level, either it's daily, weekly, monthly, or even intraday, 1 hour, 4 hour, 2 hour. So it can come at any place. And these three candlesticks usually won't be like crossing above the high. And this is like a dangerous thing, because basically, if you're trading markets, you will see that it won't be doing this kind of stuff. Even if you can't like pick this pattern till the second day, on the third day it is like visible in front. Why on earth it first of all fell down, and it took 3 days or 3 weeks or 3 months or three like candles just to eat up this fall? This is not a bullish thing. In bull run, usually this kind of candlestick comes up. Boom, boom, boom. It rises up. But here, these three candlesticks were extremely weak. They were not crossing the previous high. And once this red candlestick comes in, it's a complete signature that there is something definitely wrong. And don't sit into that stock. And that's what exactly happened. Just look at it. From here, it's February 21, 2011, and here it's July 30th, 2011. So that's what, 5 months, and it went lower, lower, lower. It never like fully recovered. That's why this pattern is important, because this pattern means continuation in downward trend, and that's not a good side to be in. Thank you.